Getting a sudden windfall, whether it's a yearly bonus, an inheritance, or selling a property, often creates an unexpected problem. Instead of feeling secure, you feel the overwhelming pressure of figuring out where to put this unallocated cash before the opportunity spills over. You know that leaving it in a savings account means losing purchasing power to inflation every single day. But deploying all of it today comes with an equally terrifying thought. What if you buy in right before a massive market crash? Unlike systematic investment plans, which use an automated engine to invest in regular increments, smoothly averaging out market volatility, a lump sum drops a massive manual lever in front of you, forcing you to actively manage all timing risk on your own. To get past the anxiety of pulling that lever, you need to build a mechanical framework answering 3 specific questions. Where do you put the capital? How much to allocate to each, and how to execute the transfer. Managing a windfall effectively requires building strict mechanical guardrails. These rules prevent you from making a catastrophic all-at-once mistake, regardless of where the market bottom actually sits. This chart maps out your primary options for picking assets based on downside risk versus potential gains. The first strategy is momentum investing. This involves buying into sectors, indices, or themes that are already actively rising. You are looking at areas like auto, realty, or US genomics, aiming to jump onto a moving trend. This chart shows the price action of an index over time. If you look at the white line on the right side, you see a sharp, steep upward climb. That is what a successful momentum run looks like in the data. The primary benefit here is speed. By identifying an asset that has already broken out, you have the potential to ride a massive upward wave and capture very high, rapid returns. But look at the center of the graph where the line plummets. That drop illustrates the extreme risk of momentum. If the trend breaks, you can face a sudden double-digit correction. Chasing momentum offers the potential for massive, rapid gains, but the mandatory trade-off is strict discipline. You have to set and obey hard stop-loss limits to survive the inevitable corrections. We can return to the quadrant chart to see the exact opposite approach. Down in the bottom left corner, you have value investing. Value investing means deliberately targeting sectors or themes that have already crashed by 30% or more, like the IT sector or US nuclear and minerals. You are buying the damage. This approach is favored by some of the most successful long-term capital managers in the world, consistently looking for assets well below historical peaks. The mathematical benefit here is your entry point. Because the asset is already heavily discounted, a large portion of the downside risk has been priced out. This creates a built-in margin of safety for your capital. The hidden trade-off is the psychological cost. An asset that has crashed 30% might move completely sideways for years before it rebounds. It requires extreme patience while you wait for the market to agree with you. Value investing gives up the immediate gratification of a momentum run in exchange for a much safer downside.
It will protect your capital, but it will severely test your patience. Once you decide between momentum and value, you have to answer the next question. How much of your money actually goes into any single idea? The simplest way to handle this is the rule of 5. You take your entire lump sum and break it down into 5 distinct, equal tranches. By capping your allocation to any single theme, mutual fund, or ETF at a strict 20% limit, you structurally protect your portfolio. If one specific sector crashes, the other 80% of your money remains insulated. There is also a lower boundary to keep in mind. If you allocate less than 10% to a theme, you do reduce your risk, but you dilute your capital so much that even a huge gain won't meaningfully impact your overall returns. By mechanically forcing your money into these 20% buckets, you eliminate the emotional temptation to gamble your entire windfall on one lucky asset. Now that your capital is divided, you reach the final and most important mechanic, physically moving the money into the market. The ultimate novice mistake is taking all 5 of those carefully planned tranches and dumping them into the market on day 1. To neutralize that day 1 timing risk, you need to use a 3-step mechanical workflow. Step 1 is to immediately move the cash out of your low-yield savings account and park it in a safe liquid mutual fund. This instantly starts generating a baseline return of around 6 to 7% while you finalize your research. Step 2 is to set up a systematic transfer plan, or STP. You use this to trickle the money out of the liquid fund and into your 5 chosen themes over a 3 to 6 month period. This creates a clear mathematical trade-off. The STP averages out your entry price over several months. You might miss out on minor gains if the market skyrockets immediately, but you completely prevent a day-one crash disaster. Safe execution means accepting that you cannot time the perfect entry. Instead, you use liquid funds and time to slowly absorb the market's volatility. To decide which of these tools to use, you have to answer one practical question about your own lifestyle. Do you have the time to look at charts every single day? If the answer is yes, you are an active optimizer. Because you can monitor the markets daily, you have the bandwidth to assign portions of your 20% tranches to momentum plays. But that means you must ruthlessly adhere to your stop-loss limits. You are actively managing high risk, and hesitation will cost you. If you lack that time, or you just want to save for night's sleep, you are a patient accumulator. You should stick exclusively to value plays that have already bled out 30 to 40% of their price. Regardless of your strategy, the core mechanics of the capital transfer remain the same. Avoid deploying a lump sum on day one. Use the liquid fund pipeline to move that money into the market over 3 to 6 months. A sudden windfall is a significant opportunity to accelerate your financial goals. Using this mechanical structure keeps your strategy grounded in math, shielding your capital from impulsive, emotional decision-making.